Asia's stocks fell on Monday due to lingering uncertainty surrounding the Fed's tightening of monetary policy and rising Chinese prices. It came after Wall Street gave a negative report. Markets are gearing up for more tightening as the Federal Reserve battles inflation, as the yield on the 10-year US Treasury note rises above 2.7%, causing the S&P 500 and Nasdaq to fall. As of closing time in Tokyo, the Nikkei closed down 0.6%, while Hong Kong and Shanghai declined by 3% and 2% respectively. Treasury yields have jumped to 2.75% this morning, sending bond prices lower. 5-year mortgage rates are currently 2.8%, and 30-year mortgage rates are also climbing to 2.755%, the highest level in years. Accordingly, conforming loans have a rate of 5.1%, and jumbo loans have a rate of more than 5.5%. Despite all the volatility, oil closed 2.3% higher at $98.26 a barrel, ending the day up 2.3%. IEA countries are expected to release additional 60 million barrels, and US release of 1 million barrels per day for 6 months has caused the price of oil to fall artificially, causing no impact on prices at the pump. The US is releasing 1 million barrels a day for 6 months, or 180 million barrels, from the Strategic Petroleum Reserve, or SPR. And the IEA countries are anticipated to release 1 million barrels per day for 6 months. China's stocks struggle, FTSE 100 lower. As inflation rose more than expected Monday, stocks with Chinese focus were hurt, as worries about the country's zero-tolerance stance on COVID-19 surfaced. London's stock market plunged as the Shanghai Composite and Hong Kong's Hang Seng Index fell nearly 3% after Beijing disclosed a 3-month high for annual price growth. Beijing's announcement came amid ongoing pandemic disruption in several major cities. Several mining stocks, including Anglo American, fell on worries about weaker economic demand, including Prudential, which sells in Asia and Africa. UK Mortgage Investment Trust, Scottish Mortgage Investment Trust, which owns shares in Chinese tech stocks such as Alibaba and Tencent, fell the most in London at 3%. While gains were made in the banking sector, Lloyds and Barclays each made 1% gains. The wider FTSE 100 fell 35.68 points to 7,633.88. EdTech company Pearson shared a 2% gain, or 11.6 points, to 773.8 points, after Goldman Sachs announced a 1,026-point price target. Aston Martin Lagonda was the biggest faller, falling 47.68 points to 21,126.64 on concerns about slower Chinese demand, just ahead of Fidelity China Special Situations' decline of 12 points to 245 points. Shares reversed 6%, or 48.8 points to 821 points. Aegis Poland, the missile defense contract the company inherited from Amic Foster Wheeler acquisition, remains the same in the carrying value of Wood Group's stock, jumping 14% after the company reported delayed annual results next week. A decline in China's related stocks is offset by an 11% surge in the Wood Group. A number of Hong Kong-based companies and mining stocks, including Anglo American, fell amid fears that new measures to curb the pandemic would have a negative impact on the economy, especially in Shanghai. Another 2% was lost by the Scottish Mortgage Investment Trust, which holds stakes in tech-oriented Chinese stocks like Alibaba. Lloyds, Barclays, and NatWest all gained over 1.5%, helping the FTSE 100 index gain 14.75 points to 7,654.81. The stock market in Europe is also down across the board. Manny Macron has a very narrow lead over repeat nationalist challenger Marine Le Pen in the first round of voting in the French presidential election. In the event of Le Pen's victory, it is said that she would deter business from entering France, even though she is anti-Euro. In other words, she opposes the expansion of the European Union's powers and further integration of Europe. Furthermore, the ECB, or European Central Bank, is scheduled to meet in Frankfurt on Thursday to discuss further policy moves. In addition to futures, US stocks were also down. Bond yields are soaring as a result of the bond market's weakness, and that is driving US stocks lower. You might think, oh, this has to do with the Ukraine-Russia war and Asia's involvement. And yes, you are correct. But the bigger issue in the US is what the Fed is about to do. Despite all its attention to inflation and the rate of inflation seen in the markets, the Federal Reserve has completely missed the ball and are now falling behind the curve. This has resulted in the stock market announcing an aggressive reprice, aggressively leaving the Dow down 4.5%, the S&P down 6%, the Nasdaq down 12.4%, the Russell down 11%, and the transports down 12.2% year to date. The government of China is still doing its best to abide by its COVID-0 policy, which has led to fears of a possible extended lockdown, which may spread to other major industrial cities, clouding a partly cloudy economic outlook for the country. As a result of Russia's war on Ukraine and a COVID-19 resurgence in China, factory gate inflation was higher than expected in March, official data shows. In spite of market volatility, GoTo's on-demand, e-commerce, and financial technology services have enjoyed strong investor interest in Southeast Asia, explaining the fast-growing need in the region and the confidence in GoTo's position as the largest digital ecosystem in Indonesia, CEO Andre Solistio said in a press release. As a result of the French election, the euro rose against the dollar during the day. Given Marine Le Pen's long-standing sympathies for Russia, investors were worried about the consequence of her victory in the presidential race. Thus, it is no surprise that the markets are confusing, not over whether they will be tightening, but the pace and increments. In addition, investors flew into a tailspin as the Ukraine crisis dragged on. With the Shanghai Composite falling 2.2% this morning, markets in Europe are also set for a weak session due to China's more than expected inflation figure. Despite the first 2 weekends of French polling, CMC markets expect the Paris-based CAC 40 to fall 39 points to 6,510 following the weekend, while the FTSE 100 is expected to drop 42 points to 7,627 following this weekend's elections. Markets, however, have remained resilient as discussions under the surface speculate if the US CPI data from March will point to the peak of the inflation cycle and help the Fed engineer a soft landing, however difficult that may be. Let us know your thoughts in the comment section below. Please remember to like, share, and subscribe to our channel. Your support means a lot to us. Thanks! And as always, see you in the next video.